Did you know that 90% of traders say market sentiment influences their trading decisions? This statistic, while surprising, isn't devoid of reason. It's more than just a number. It's a testament to the power of market sentiment. Now, you may be wondering, what exactly is market sentiment? In the simplest terms, market sentiment refers to the overall attitude of investors toward particular security or financial market. It's a complex, multifaceted concept that has far-reaching implications for traders worldwide. At the very heart of market sentiment is the emotional atmosphere that surrounds a market or a specific security. It's the combination of optimism or pessimism, fear or greed, confidence or uncertainty that investors collectively feel. It's also their collective judgments, informed by a mix of factors including economic indicators, political scenarios, corporate earnings reports, and global events. This amalgamation of elements feeds into the larger sentiment that influences investors' trading decisions. Market sentiment, however, is not just a reflection of emotional states. It's a reflection of the collective intelligence of the market, a sum of all the knowledge, intuition, and wisdom that investors bring to the table. It's this collective wisdom that gives market sentiment its power, its ability to influence. Now, consider this. A trader must grapple with a multitude of variables before making a decision to buy or sell. These variables could include everything from the latest financial news, corporate earnings reports, economic forecasts, geopolitical events, to even the weather. So it's no surprise that the overall mood of the market can serve as a crucial guiding light in such a complex environment. It's interesting to note that market sentiment isn't just a buzzword in finance. It's like a living entity, constantly evolving and with the market's flow. It's a barometer of the market's health, a gauge of its direction, a compass that helps traders navigate through the myriad complexities of the financial world. When it comes to market sentiment, it's not just about what the majority of traders are feeling. It's about power of their collective emotion, the strength of their conviction, the depth of their belief. These emotions are not some abstract concepts, they are palpable forces. Just like the wind, one may not be able to see market sentiment, but its effects can definitely be felt. When optimism reigns, markets can soar to new heights. When fear takes hold, markets can plummet. It's this dynamic that savvy traders understand and utilize in their strategies. And here's the most fascinating part. Market sentiment isn't just a reactive force. It has the potential to be proactive as well. When sentiment is bullish, it can inspire confidence and encourage more trading activity, leading to a self-reinforcing upward cycle. Conversely, when sentiment is bearish, it can trigger sell-offs and depress trading activity, leading to a self-reinforcing downward cycle. With all this in mind, the surprising statistic that 90% of traders say market sentiment influences their trading decisions isn't really surprising after all. It underscores how significant the role of market sentiment is. It's a crucial tool that assists traders in deciphering the market's direction and mood. It's that guides them through the complexities of the financial landscape. And let's not forget about that surprising statistic, 90%. That's a significant majority of traders who consider market sentiment as a key factor in their trading decisions. So it's clear that understanding market sentiment is a crucial tool for successful trading. So, what exactly is market sentiment, and how can we analyze it? Market sentiment, in its simplest form, is the collective mood or attitude of investors towards the market. It's the general feeling or tone that pervades the marketplace, influencing buying and selling decisions. It's like the market's emotional pulse, if you will. Now, think of market sentiment as a pendulum that swings between two extremes, optimism and pessimism. When the majority of investors feel positive about the market, we say the market sentiment is bullish. On the flip side, when investors are primarily negative, we say the sentiment is bearish. But how does one measure this seemingly nebulous concept? Well, it's not as elusive as it sounds. There are key indicators that can help us gauge the market sentiment. Let's break them down, shall we? First, we have price action. This refers to the fluctuations in the price of securities. By studying price movements and patterns, traders can get a sense of the market's sentiment. If prices are on an upward trend, it suggests a bullish sentiment. Conversely, a downward trend might indicate a bearish sentiment. Next up, we have volume. Volume represents the number of shares or contracts traded in a security or market during a given period. Simply put, it's the total amount of trading activity. High volume often implies strong investor interest and depicts a more active market. This, in turn, can signal strong market sentiment. Finally, we have news events. News can significantly impact market sentiment, whether it's a major economic announcement, a geopolitical event, or a corporate earnings report. News can trigger shifts in sentiment, causing the market to react. Now, it's important to remember that these indicators are not infallible. They are tools to help you make informed decisions, not crystal balls that predict the future. Now that we understand the basics of market sentiment, we can dive into how to use this knowledge in trading. And remember, the key to successful trading lies not just in understanding market sentiment, but in knowing how and when to act on it. Applying market sentiment to your trading strategy might seem complicated, but it can be broken down into simple steps. Now, let's dive into the nitty-gritty of how you can incorporate market sentiment into your trading practices. The first step is to stay informed. This means keeping a finger on the pulse of market news and events that could potentially influence the sentiment. For instance, economic indicators, earnings reports, geopolitical events all come into play. So, make it a habit to follow reliable financial news sources and keep track of upcoming market events. Next, keep a close eye on volume and price action. Volume refers to the number of shares or contracts traded in a security or market during a given period. If volume increases on a price advance, this typically indicates positive sentiment, and vice versa. Similarly, price action can give you a glimpse into market sentiment. If prices are increasing, it suggests bullish sentiment, while decreasing prices indicate bearish sentiment. By understanding these trends, you can make informed trading decisions. Lastly, it's crucial to stay flexible. Market sentiment is like the wind. It can shift rapidly and without warning. Therefore, your trading strategy should be adaptable to these changes. For instance, if the market sentiment quickly shifts from bullish to bearish, you might need to adjust your positions accordingly. Staying rigid in your strategy could potentially lead to losses, so it's essential to be adaptable. Incorporating market sentiment into your trading strategy isn't a one-size-fits-all approach. It's a tool that, when used correctly, can enhance your trading decisions. It's also important to note that it's not a standalone tool. You should still consider other factors like fundamentals, technicals, and your risk tolerance while making trading decisions. Remember, incorporating market sentiment into your trading strategy is not a guarantee of success, but it can certainly give you an edge in the market. So go ahead and use this knowledge to your advantage.